Okay, hello everybody. I just want to go through the basics of balance of payments. So this is going to be a fast and high overview. So in economics, there are going to be transactions between nations, all right? So if there is a country like Australia and a country like China, Australia might, export stuff to China. So China is importing stuff. So Australia might export stuff, and then China will in return pay them cash. And this is a type of financial transaction. And there are many more types of financial transactions. And we want to generalize it. So as economists, we could then go on and, make graphs and make sense of it. So let me get into it. So transactions. So we can split these transactions into two main things. One, is it reversible? And two, non-reversible earnings. So when you go reversible, right? Reversible earnings, and on this side, non-reversible earnings. Okay, now what do I mean by this reversible, non-reversible, blah blah? Well, what I mean, let me just rearrange it properly. Okay, what I mean by whether it's reversible and non-reversible is it going to come back? For example, let's say this is Australia and this is China, right? And let's say China lends money to Australia, okay? Principal. China is giving Australia some principal. Like, you might buy it. Then, what is this? For you, this is a cash inflow. This money is coming into Australia. Because it's an inflow, this is a credit. Alrighty, so this is good. Money is coming into the Australian economy. But however, you have to repay this because it's a loan. You have to repay the principal. Therefore, this is reversible. What is happening? It's a two-way transaction. It's coming to you and then it's going back. So in this aspect, okay, sure, it's reversible. But then you don't just pay them the interest, you pay them the principal, you have to also pay them the interest. And this interest bit is non-reversible because they're not going to send you back anything. That's, the fee. Why do they charge interest? Because interest is the cost of borrowing funds. So that is the cost of borrowing with a fund. So yeah, so that's non-reversible. And that's what I mean. Therefore, this would be categorized as a non-reversible transaction because you're paying it back with interest. Already? All good. So then what they do is when they look at non-reversible and non-reversible, we go into this thing. Let's circle around this. Yeah. Okay. So it's either reversible or non-reversible. Okay, now what you do is that under reversible, this is called the current account. Guys, I'm just struggling. I don't know why I'm wasting my time doing this, but you might as well. God damn it. What the hell? Okay, that's good enough. So non-reversible earnings are known as, let me increase this thing, the capital account. And this one is known as the KAFA. Why the KAFA? Well, this is the capital account, right? KAFA is what we're calling this is the current account. See, I already made the mistake. That's why we call it KAFA. I already made the mistake. Current, yeah. So if it's non-reversible, if it's like one way, that's a current account because that's immediate. What's a current account? Current account is anything that's happening right now. So it's like what's currently happening. So it's like short term relatively. And KAFA is capital and financial accounts. So that's the combined. Okay. Now, under the current account, we have several factors. So when I set current accounts relatively short, right, transactions that are short, we look at three main categories. One is BOGs. What's BOGs? BOGs is the balance of goods and services. BOGs. Then we look at NPY. NPY. And then we look at NSY. All good. Now, when we look at BOGs, what's BOGs? BOGs is X&M, okay? It's related to the exports and imports in the short term. Alrighty. And then what's NPY? NPY is the net primary income. So net primary income, and this is the net secondary income. So the net primary income is interested in returns on financial investments. Returns on financial investments. All good. And then the NSY is all other miscellaneous earnings. Other miscellaneous earnings. So all you need to know, if it's a net secondary income, it's miscellaneous. And if it's a primary income, well, it's transactions that are related to returns on financial investments. So that, bro, is all you need to know on the current accounts. I mean, of course, we're going to go into depth, but then that is the high level overview. Then you can do the same on this side for KAFA. Also, one thing to note is that in the HSC syllabus, there is a bigger emphasis on the current account. Majority of the questions are asked in the current account, so I would advise you to keep your notes on the KAFA relatively brief, or as long as you can understand it, you're like fine. Okay, so under KAFA we have two things. Of course, as it's stated here, we have the financial account, and then we also have the capital account. So inside this financial accounts, right? What are financial accounts? Well, the financial account is just referring to the transfer of financial assets. What are these assets? It's like anything that has monetary value. So like shares, loans, property, even maybe investment into a company, all that. So then we can we can split this into a couple of categories. First one would be direct. Second one would be portfolio. Then we would have derivatives, financial derivatives. So these are things like forward, swaps, options, contract. I'll go into that in detail in another video. So there is direct, portfolio, derivatives, reserve assets, and other. So this is all other miscellaneous. All good. So under reserve assets, these are like, your I actually don't know what reserve assets are, so I need to look into that. But direct, it's just long-term investments, no speculative gain. Portfolio, speculative gain, short-term. So how can this long-term direct investments be classified as? Well, something like less than 10%, greater than 10% ownership or like stake in a company, because that, if you're owning like more than 10% of a company, right, you're not like going to sell it immediately. That's like the assumption. You might if you're a psycho, but like generally speaking you're not. But then portfolio, the way I would think about it is that you have a portfolio. Like, what does a portfolio look like? An investment portfolio, well, small chunks in a large range of stocks. So that's portfolio. You're not going big on anything, it's just small, so it's less than 10%, and it's relatively short term, so it's speculative gains. And yeah, these are just forwards, exchanges, all that. So this is what you would call under the financial account. Then we can also split it under the capital account, because that's KAFA. financial, and this one, capital account. And under the capital account, it's nothing big really.
Investment sub-account includes other forms of reversible transfers of financial
This is
assets
what I would
that
say
are not
about the
categorized
capital
as
account.
above. And finally, we have the capital account to, again, record reversible transactions, but this time for non-financial assets, such as intellectual assets like patents, copyrights, or franchising licenses. So if you follow the rules in this flowchart, you should be able to...
Exactly. Patents, intellectual property, etc. By the way, that was my good friend. Don't worry about it. But yeah, this is basically how you could. This is like basics or like a high overview of the balance of payments. So yeah, all good. Thank you for listening. Have a good day.